The price is telling you gold is liquid and everywhere. Yet the physical market is acting like it S-rationed, and that disconnect is exactly where the next move gets decided. Because while everyone's hypnotized by the headline number on a screen, the real signal is leaking out through the boring stuff. Ship dates, withdrawal cues, and the quiet widening between spot and what it costs to actually hold metal in your hand. And if you stay with me, I'm going to give you 3 concrete payoffs you can use immediately. The hidden bottleneck that explains why bars feel scarce even when the world has plenty of gold. The calendar trigger that can force a nasty squeeze or shakeout over the next 1 to 2 weeks. And the specific levels and stress indicators that tell you whether this is just heat or the start of something structural. Here's what most people are missing right now. Gold has moved into a different psychological regime. It didn't just drift, it jumped. Today it pushed through the kind of round number threshold that changes how every participant behaves, from dealers to hedgers to the biggest balance sheets on the planet. And the second that happens, the market stops being a price. It becomes a process of who can source metal, who needs to hedge exposure, who is forced to pay up for immediacy, and who gets shaken out when volatility spikes at exactly the wrong time. And that's where the real pressure starts. If you've tried to buy common gold bars recently, nothing exotic, just widely recognized sizes, you've probably seen the tells. Pre-sale, expected ship date, back order, notify me. The kind of language that doesn't show up when inventory is comfortable. And even when something is available, the add-on over spot can feel like it has its own pulse, widening and tightening with no obvious relationship to the daily candle. That's not conspiracy, that's market plumbing. And the next detail is what flips the whole setup. Because the hidden detail is this. Gold supply and not gold bars you can actually take home this week are 2 different products. That sounds simple, but it changes everything. The world can have plenty of raw gold in the system, vaulted, allocated, unallocated, sitting in institutional inventories, while retail bars and coins still feel tight. Why? Because the bottleneck isn't always the metal. It's the conversion layer, refining, fabrication, assay, casting, minting, packaging, shipping, insurance. And the moment demand surges, that conversion layer turns into a choke point with real lead times. Paper can expand instantly. Fabricated product can't. And that mismatch is where scarcity is born. Think about what happens when price rips higher into new highs. Dealers don't just sell, they manage risk. They have to. If you're a dealer selling physical, you're not simply placing a bet on direction. You're running inventory, managing replenishment, protecting yourself against a fast reversal, and making sure you're not the one left holding exposure when the market whips around. So what do dealers do when volatility spikes and supply chains get stretched? They widen premiums, they throttle availability, they push pre-sales, they extend delivery windows. Not because they're trying to be dramatic, but because their risk manager is looking at the same chart you are and thinking, if gold drops hard tomorrow, I could be the one who sold a mountain of product today and then has to restock into a falling market while customers disappear. And if gold spikes again tomorrow, I can't be the one who promised delivery I can't meet. So they price in uncertainty. That it's what you were feeling when harder to find starts showing up in everyday buying. But that's not the part that matters most. The part that matters is how this ties into market structure. The difference between price discovery and delivery, between futures hedges and physical fulfillment, between I can trade it and I can source it. Gold's headline price is overwhelmingly a paper-driven discovery process. Futures, forwards, swaps, OTC flows, huge volume, tiny friction, instant execution. That's why the spot price can look calm even while physical feels strained. The paper market is like a high-speed signal system. The physical market is like freight and warehousing. And when the paper signal says, go faster than the freight system can respond, you get tension. That tension shows up as premiums, delays, and local dislocations. And those dislocations can feed back into paper in one very specific way. Through arbitrage and delivery stress. Here's the mechanic. Clean and simple. If there's a consistent premium in one hub versus another, say New York pricing effectively richer than London, metal moves. It has to. That premium becomes a magnet. Traders who can access the logistics, the vaulting, and the financing will ship bars across the Atlantic because the spread pays them to do it. It's not about ideology, it's about math. But when enough metal gets pulled from one place into another, you create a localized tightness that has nothing to do with global scarcity and everything to do with where deliverable supply is sitting right now. And once that happens, the market starts doing something you can feel. Longer withdrawal times, thinner liquidity for specific bar types, more sensitivity to delivery windows. Because if this one level breaks, the math changes. We saw a version of this dynamic when gold stockpiling in New York drained liquidity from London. Financial market reporting described how large amounts of gold moved into COMEX vaults in response to tariff fears and pricing incentives, and that this flow contributed to withdrawal delays from the Bank of England BASA-S vaults, reported as stretching to weeks rather than days. That's a huge tell, not because it means there's no gold, but because it means the system is operating near its logistical limits. And logistical limits are where premiums are born. Let's translate that into what it forces participants to do. If you're a large holder who suddenly wants to move physical out of a vault, the waiting line matters a lot. It changes your optionality. If you're a market maker who normally relies on being able to source or swap metal quickly, longer queues reduce your confidence and reduce your willingness to quote tight spreads. If you're a bullion bank hedging exposure, you start caring more about timing and less about theory. And if you're a retail investor trying to buy bars, you're downstream of all of it. You see it as harder to find. But upstream, it's really the chain is stretched. Now zoom out. This is where people get fooled because they think physical tightness must mean some dramatic total shortage. Not necessarily. Sometimes it's simply a surge in demand hitting a system built for steady flow, not sudden waves. Refiners and mints don't keep infinite spare capacity. They staff, plan, and source based on expected volumes. When demand spikes, you don't instantly get more manufacturing lines. You get queues. And you get rationing by price. Premiums rising, not because someone is evil, but because demand is bidding for priority. And it's not just retail. The physical market has multiple demand channels, and when they hit at the same time, things get weird. You can have ETF flows pulling ounces through the financial system. You can have central banks continuing to add to reserves as part of long-term diversification, away from reliance on fiat and sovereign debt. And you can have private buyers, individuals and family offices, seeking the kind of asset that doesn't depend on someone else's promise. When those three currents line up, the market stops feeling two-sided. It starts feeling like a one-way door with occasional violent swings. That last phrase matters. Occasional violent swings. Gold can whip around even when the thesis is correct. In fact, the stronger the underlying bid, the more violent the shakeouts can be. Because volatility is how the market transfers money from impatient hands to patient hands. This isn't moral, it's structural. Large players use volatility to manage entry, to force weak hands to liquidate, to reduce crowded positioning, and to reload exposure at better levels. So if you think harder to find bars automatically means a straight lineup, you're setting yourself up emotionally. And emotional mistakes are the expensive kind. But let's keep stacking proof, because in this market, you don't win with one argument. You win by layering mechanisms. Proof point 1 is the street symptom we already talked about: availability language and delivery windows. That's qualitative, but it's real. It's the first ripple. Proof point 2 is the institutional plumbing. The documented movement of gold inventories between hubs when pricing incentives and policy fears appear, and the consequence, withdrawal delays and reduced liquidity in the hub being drained. That's not a rumor. That's how arbitrage works when spreads open. Proof point 3 is vault transparency. London Vault Holdings data is published monthly, and while the tonnage can look large, thousands of tons, the key is that large does not mean instantly deliverable to everyone who wants it this week. There are categories, ownership structures, and operational constraints. And when a market begins caring about dates rather than just price, those constraints stop being academic and start being price signals. Proof point 4 is flow behavior. In late 2025, multiple markets reported strong investor interest in gold exposure through ETFs in several regions, including notable inflows in India's gold ETF market. That adds an important layer because it shows demand isn't only a retail altcoin shop story. It's financial allocation. Proof point 5 is the macro regime backdrop. Gold pushing through a major milestone this week has been attributed in mainstream financial coverage to a mix of geopolitical tension, fiscal sustainability concerns, and currency dynamics. You don't have to agree with every narrative detail to see the mechanism. When investors believe the real risk is not a single recession, but a longer-term credibility issue, debt deficits, debasement risk, or policy instability, gold stops behaving like a trade and starts behaving like a reserve asset. Now, here's the part everyone's watching, and the part they're missing. Most people stare at the spot price and say, if gold is at this level, why aren't bars everywhere? Because they're assuming the spot price is the price of a bar. It isn't. It's the price of a standardized financial unit of gold in the wholesale system. A bar you can hold is a different object with different costs and constraints. Fabrication fees, distribution costs, inventory financing, counterparty risk management, even packaging and security matter more when demand spikes. So the premium can widen while spot does its own thing. And that premium is information. It's the market telling you where stress is. This is where paper versus physical becomes finance, not internet drama. In a calm regime, paper and physical track closely because arbitrage is easy. In a stressed regime, frictions widen because arbitrage takes time and balance sheet. If your system is already stretched, you can't instantly close the gap. So the gap persists longer. And the longer it persists, the more it attracts players who can monetize it. Shipping metal, rolling hedges, repositioning inventories. That activity can create feedback loops. Here's one feedback loop that's underappreciated. When premiums rise and availability tightens, it can increase psychological demand. People see scarcity and rush. That's behavioral. But then dealers, seeing demand surge, pull back supply to avoid getting run over. Premiums rise further. That attracts even more urgency. This is reflexivity. Not because the world ran out of gold overnight, but because market participants respond to price and availability, and their responses change the system. And that's where the real pressure starts. Now let's talk calendar. Because why now is never just because people are scared, or to markets move on deadlines, on funding cycles, on option expiries, on month-end and quarter-end positioning. And this week has a special ingredient. We in the early part of the year where portfolios are being rebalanced, risk budgets are being set, and big funds are deciding what they're willing to own into a potentially unstable macro regime. When gold is ripping, it forces decisions. If you're underweight and it keeps running, your tracking error grows. If you chase at highs and it snaps back, you look reckless. So institutions become hypersensitive to levels and to volatility events around key dates. Thin liquidity windows, where fewer players are willing to offer size, can amplify moves. Weekend gaps can amplify fear. Month-end flows can turn a trend into forced behavior. The calendar is the catalyst because it compresses decision-making. And that brings us to one of the most important mechanics for the next 1 to 2 weeks: positioning and forced buying. I'm not going to pretend we can see everyone's book, but we can understand incentives. When gold breaks a major level and holds, risk managers adjust. Short positions become more expensive to carry. Stop-loss levels get triggered. Margin requirements can rise as volatility rises, and that creates a cascade. Shorts cover, which pushes price, which forces more covering. That's not a conspiracy. That's how leveraged markets behave when they're on the wrong side of a breakout. At the same time, dealers who sold physical hedges on futures have to manage their hedge ratios. And if the market gets jumpy around key strikes and expiry, hedging can become more aggressive. Options can add fuel. Delta hedging can create reflexive buying when price rises through certain zones, especially if there's a concentration of open interest near round numbers. That's why certain levels feel like they have gravity, not magic, mechanics. Now I want to do a quick reality anchor, because this is where people either get smarter or get sucked into fantasy. It doesn't take everyone buying gold to create retail scarcity. The retail bar and coin market is a thin slice sitting on top of a much larger wholesale system. If even a small fraction of financially liquid demand decides they want physical delivery rather than exposure, the conversion layer gets stressed. Think of it like this. A city can have plenty of water in reservoirs, but if too many households try to fill swimming pools in the same week, the neighborhood pressure drops. It's not because the city ran out of water. It's because the distribution system was not designed for that surge. Same with bars. You're not buying gold in the abstract. You're buying a manufactured, verified, deliverable object. The system that produces those objects has throughput constraints. And once you understand that, the phrase harder to find becomes less mysterious and more actionable. Because you stop asking, is there a secret shortage? And you start asking, where are the bottlenecks and are they getting worse or easing? That's the trader's question. That's the investor's question. That's the only question that pays. So what do you watch? You watch what can't be faked. You watch premiums over spot for common products. If premiums keep widening even when spot pauses, that's physical demand staying hot. You watch delivery times and back order language. If ship dates move out while price consolidates, that's not normal calm behavior. That's a stressed pipeline. You watch the curve and the spreads. Gold typically carries costs, storage, insurance, financing, so it often trades with a certain structure in forwards. If the structure tightens in a way that suggests urgency for near-term metal, that's information. Even if you don't memorize the jargon, you can understand the concept. When immediacy is valuable, the front end gets bid. You watch cross-market comparisons. If New York stays richly priced versus London, it encourages transatlantic pulls. If that premium fades, the pull eases, and some stress can normalize. You watch institutional behavior. ETF flow tone matters. Central bank purchase tone matters. And even when you don't have perfect real-time transparency, you can observe the macro environment that encourages reserve diversification. And most importantly, you watch the emotional manipulation pattern, because this market will try to trick you. Here's how it usually goes when a trend is real, but volatility is weaponized. First, you get a surge that makes everyone feel late. Then you get a nasty reversal that creates headlines about the top. Then you get a dead cat bounce that convinces people the reversal was a fluke. Then you get another drop that makes them quit. And then, only then, does the market resume the trend with fewer passengers. That's the dance. It's designed to hurt the most people possible, because the market is not here to validate you. It's here to discover a price by extracting emotional premiums from participants. So you need a psychology shield, separate trend signal from noise. Trend signal is structure, higher highs and higher lows, sustained physical tightness signals, spreads that stay supportive, repeated dip buying with fast recoveries. Noise is intraday drama, headline spikes, and random liquidation cascades. The thesis can be right, and the path can still be violent. If you can accept that, you stop making panic decisions. Now let's frame the next 1 to 2 weeks with a simple 2-scenario lens, because this keeps you honest and stops you from falling in love with a single narrative. Scenario 1 is the controlled pullback and retest. Gold has surged into a psychological zone. It's normal, even healthy, for it to breathe. In this scenario, price pulls back toward the most recent breakout area, tests it, and either holds or wicks through and recovers. What confirms this scenario is stability in physical signals during the pullback. Premiums don't collapse, delivery times don't suddenly normalize overnight, and dips get bought with conviction. In this scenario, the market is shaking out leverage, cooling sentiment, and resetting risk. This can feel scary in real time, because it always does, but it's the market building a base. Scenario 2 is the continuation squeeze, the gap risk scenario. In this scenario, price doesn't give everyone a clean entry. It consolidates briefly, then pushes higher through the next round number zone, forcing hedgers and shorts to react. Liquidity thins, forced buying appears, and you get sharp intraday ramps that feel almost unnatural. The tell here is not just the spot print, it's the behavior around it. You'll see spreads stay firm, you'll see physical product order remain tight, even as price climbs, and you'll see the market shrug off bad headlines. In this scenario, the market is not deciding with logic in the moment. It's being pushed by positioning and deadlines. That's why it can feel like it's ignoring fundamentals. It's not. It's obeying mechanics. Both scenarios can happen while the broader story remains intact. Both scenarios have a key risk, volatility. Volatility can spike in either direction. If you're not mentally prepared for that, you'll get whipped out of your own plan. Now let's talk levels, but in a finance literate way, not as superstition. Levels matter because they are where positioning and risk management flip. The first level that matters is the breakout zone, just below where we are now, the region where price transitioned from high to new regime. When the market revisits that zone, it's a test of conviction. If it holds and bounces, that's a signal the bid is real and participants are willing to defend it. If it slices through and stays below, that suggests the move may have been more speculative and less structural, at least in the near term. The second level that matters is the round number threshold we just crossed, because round numbers attract options open interest and human attention. If price can stay above it on closes, especially into a weekend or into month end, it changes the psychology of underallocated players. It forces them to reassess what expensive even means. The third level that matters is the next extension zone above, where momentum funds and trend systems often add exposure if price action stays strong. In that area, continuation can become self-fulfilling for a time, because systematic strategies often buy strength and sell weakness. That doesn't last forever, but it can drive sharp legs. And now the most important part, what invalidates the thesis, at least in the near term? If physical tightness signals start easing quickly, premiums compressing meaningfully, delivery times snapping back, product availability normalizing, while spot remains high, that suggests the harder to find narrative was more about temporary bottlenecks or panic buying than sustained demand. That doesn't mean gold collapses, but it weakens the claim that physical demand is building into something persistent. If the cross-market premium dynamics that incentivize metal movement fade and the logistical cues shorten, that also reduces immediate stress. And if the macro backdrop shifts suddenly toward a regime that is unambiguously hostile to gold, think a sharp sustained strengthening of the dollar combined with a credible shift toward tighter real yields and reduced fiscal anxiety, then gold can absolutely pull back hard, even if the long-term case remains. Markets can reprice quickly. They don't send invitations. So here's the practical roadmap. The checklist for what comes next week, the kind of thing you can actually watch without needing a Bloomberg terminal. First, watch whether common retail products stay constrained. Not one anecdote, pattern. If pre-sale language and ship dates persist across multiple major outlets, that's a sustained signal. Second, watch premiums. If spot chops sideways but premiums remain elevated, that's physical demand refusing to cool. Third, watch the spread behavior between major hubs. When pricing incentives to move metal appear, they matter. When they disappear, they matter too. Fourth, watch how gold reacts to stress headlines. In a real trend, gold often shrugs off reasons to sell and sells off hardest when the news is good, because that's when positioning gets cleaned out. The reaction function matters more than the headline. Fifth, watch the calendar. We're in a window where positioning decisions are compressed. If gold closes the week strong, it can force underweight funds to chase. If it closes weak after a parabolic run, it can invite a sharp pullback. The closes matter. And right here is where most people make the wrong psychological move. They confuse urgency with clarity. They feel like they must act because the market is moving. But what actually builds long-term success in markets is not reacting faster, it's reacting smarter. It's knowing what you're watching and why. It's respecting that price can whip around violently even if your thesis is correct. It's having a plan for both scenarios so you don't get emotionally hijacked. Now, one more layer before we close, because this is the detail that makes the whole story cohesive. When physical demand builds, it doesn't always show up first in spot. Sometimes it shows up in friction, in the cost and time to turn exposure into possession, in the willingness of dealers to commit inventory, in the willingness of the system to deliver quickly. Those frictions are the early warning system. They're the whisper before the scream. And when the whisper persists, while price is breaking into a new regime, it suggests something deeper than a headline trade. It suggests a shift in preference, a shift from owning claims to owning the thing itself. That shift doesn't need everyone. It needs enough. Enough to stress the conversion layer, enough to keep premiums firm, enough to make delivery windows matter, enough to force the paper market to respect the physical calendar. And once that starts, it doesn't unwind cleanly. It unwinds with volatility. So here's my base case. A volatile consolidation or pullback that tests the breakout zone with physical tightness staying stubborn. And then another attempt higher if the macro anxiety bid remains alive. And here's the squeeze case. A brief pause, then a continuation leg where the market forces participants to chase through higher zones with gap risk around thin liquidity moments and key closes. And here's the one thing I want you to remember when the next violent move hits, and everyone starts trying to emotionally steer you with narratives. Watch the physical friction, watch the premium, watch the delivery time, watch the structure. Because price can lie in the short run. Friction usually doesn't. If you were the kind of person who'd rather understand the mechanism than argue with the headline, you're my people. Stay close to the signals that can't be spun, keep your emotions out of the candle, and when the crowd gets loud, get more precise. We're not here to be entertained by volatility. We're here to read it.